Good afternoon, everyone, and welcome to today's webinar on building a resilient portfolio through non-traditional investments. I'm very pleased to have with me today my very learned friend, Kelvin Tay. Kelvin is the regional CIO of UBS, and he's also an adjunct professor at NTU's Business School. So very glad to have him here with us today. Okay, before I hand over to Kelvin for this exciting Q&A segment, we will be launching a few poll questions, so please respond accordingly. Getting the results in, and it looks like there's a lot of interest in private equity and venture capital today, a growing interest in private credit, hedge funds, and digital assets. For poll 2, very, very happy to know that all the participants today have already invested or allocated into private markets. So that's fantastic.
Yeah, I think the interest in the private markets have actually picked up quite strongly in the last, I would say, in the last 5 years, actually, largely because of the growth of the tech sector, and because of that, the information, the education actually came in. So a lot more people are aware of the private markets now compared to like 10 years ago.
Just getting started, Kelvin, we should paint the macro backdrop currently with inflation, rising rates, your views, your suggestions.
Sure. Well, first off, I want to thank ADDX for inviting me, and thank you for having me. We've quite a fair bit to cover this afternoon, and I hope that I can actually answer all your questions. If you have any questions, please feel free to send them through to Jocelyn, and Jocelyn will get them through to me. But I just want to paint a bit of a picture first to basically give you an idea what's going on in the markets at the moment. Now, as you can see, the markets have actually been very, very volatile. And that's largely because of this slide here. You can see that the consumer price index, or headline inflation as we call it, has actually gone through the roof. It is basically at 40-year highs right now. And there are a multitude of reasons for this, right? In the last 20 to 30 years, whenever we had very high inflation, it was all largely because of a war in the Middle East, because oil prices have actually gone up. But this time around, it is actually quite different. The inflation that we're getting right now is very multifaceted, very multidimensional, and therefore it is a lot more challenging to actually try to bring it down in that sense. And that's what the markets and the central banks are actually struggling with at this point in time. Now, if you look at this slide here, it basically shows you what's actually feeding into inflation at this point, right? You have very high commodity prices. Commodity prices were already high before the war in Russia and Ukraine. It is largely because of a structural deficit in demand and supply. And then we have the global supply chain disruptions caused by the COVID-19 pandemic. And in the last couple of months, that problem has actually been exacerbated by the zero COVID policy in China, which basically resulted in quite a few factories closing, manufacturing being disrupted. And China is a very important part of the supply chain, the starting point, and usually the ending point as well before the goods get finished and sent to various countries for sale. So if there is a disruption or delay in China, it basically disrupts the entire process, right? Then you also have the very tight labor market. Now in the US right now, the jobs gap is basically about 5.6 million. Now what do I mean by that? It means that the number of jobs available and the number of workers available to fill those jobs, the gap is basically 5.6 million. That has actually increased from about 5.3 million previously. So that number is not coming off, and as long as that gap remains at these levels, it's a gap that we've not seen all the way to the post World War II period. As long as this gap remains, wages will be trending upwards, right? And of course, if wages goes up, then obviously inflation is not going to come off. Then on top of that, because of these problems here, what the Federal Reserve is trying to do is that they're actually trying to hike rates, make it expensive for people to borrow, to invest, to buy a property, to buy a car, to consume, or make it expensive for factories, for businessmen to actually expand their operations, right? And that's one of the reasons why they are actually hiking interest rates. And on top of that, they are also withdrawing liquidity from the markets. They are trying to actually reduce the balance sheet and bring the balance sheet down to a more palatable level of about 6 trillion by the end of 2024. And that's a soft target, and I'll talk a little bit about that later on. Now, the Russia-Ukraine war, from this slide here, you can see why the war actually started, right? Because Ukraine is basically the buffer zone between Russia and NATO. And from this slide, you can also see that that NATO has actually expanded quite significantly since the end of the Cold War back in the late 80s, early 90s, right? So the Russians, feeling insecure, decided to actually launch war. But the problem is not that. The problem is the fact that, Russia is the world's biggest commodity producer by far. If you look at the bar charts on the left, you can see that Russia is the biggest gas exporter in the world. If you look at the chart on the right, you can see that Russia is the second biggest producer of oil. So if you combine both together, Russia is by far the biggest producer of energy in the world at this point, right? So the biggest supplier. So obviously, supplies are likely to be affected as a result of the war. In fact, yesterday, the EU actually announced that they will actually reduce by up to 90% oil supplies coming in from Russia. And as a result of that, oil prices yesterday actually jumped to about $122 per barrel where Brent is concerned. Okay, because if the EU doesn't want to buy oil from Russia, they have to buy oil from somewhere else, or they can actually rely on alternative energy, right? But at this point in time, alternative energy sources such as solar, hydro, or nuclear is not enough to actually replace the supply of oil coming in from Russia. And as a result of that, they have no choice but to buy from elsewhere. And that basically means that they're likely to actually push prices up because they are likely to buy from the same sources that Singapore and the rest of the ASEAN region or Asia is actually buying from as well. Okay, so oil prices have actually jumped up. On top of that, if you look at which countries are likely to be most affected by oil, if you look at these two pie charts here, it is basically the EU. The EU is very reliant on oil and gas from Russia. So as a result of that, we do think that inflation in the EU is going to get worse. Now, in fact, yesterday, where headline inflation came out from the EU itself, headline inflation is actually very high. It came in well above expectations. In fact, it's coming in at about 8.7% for Germany, right? And this is the post-World War II high. Not even in the last 40 years, it's the post-World War II high, which means that the EU will have to act sooner rather than later. Now, you need to bear in mind that at this point in time, the EU, for some strange reason, is still, or the ECB for that reason, is still printing, and you still have negative interest rates at 0.5%, right? Which is really, really strange, something that I don't understand as well. So the debate right now is whether the ECB will hike by 50 basis points next month or by 25 basis points, next month being July, because we're 1st of June, right? And as a result of that, the asset classes have actually reacted. The euro dollar has reacted, has actually moved from 104 in the last 2 weeks to about 107 because of the fact that if the EU starts to hike or the ECB starts to hike, the gap between the US dollar and the euro will start to narrow. And therefore, the flows are starting to move back to the euro itself. The European bank share prices have actually moved up as well because, in the last 12 years, they've been sitting on negative interest rates, which is really terribly bad for the margins. Now that the rates are going back to neutral and perhaps positive by the end of this year, that means that for most of the European banks, their margins, the net interest margins, are likely to actually improve quite significantly. So the European banks have had quite a nice run where the share prices are concerned. Now, commodity prices are high. So are we in a fifth commodity super cycle? There have been 4 so far, and I think we are pretty much on the at the start of the fifth commodity super cycle. And these are the reasons I've actually listed for why I think there is actually a fifth super cycle going on, right? Even the movement into ESG, right? That's going to spark a strong super cycle too, because of the fact that you need your metals for EVs, your batteries, your photovoltaic panels, so on and so forth. And there's of course a shortage of that at this point in time, because in the last 10 to 15 years, there has been a structural underinvestment. You can't increase supply on a short-term basis. Economics 101, supply cannot be increased on a short-term basis. So what the central banks are trying to do is that they're trying to reduce demand, right? You try to reduce demand. So if demand comes off and your supply goes up on a longer-term basis, you have supply and demand meeting again, and therefore prices will correct, right? Because if you have this situation where you can't increase supply on a short-term basis, that means that prices are very, very elastic, right? So they will be responsive to changes in demand in that sense. Okay, so those are the reasons why. Now, the supply chain disruptions. This was an article that I wrote last year, listing out all the reasons why supply chain disruptions will cause inflation to be strong. And unfortunately, almost 9 months have passed, and yet we still can't resolve the situation. Now, a couple of days ago, China announced that they will open up Shanghai again. So they've actually eased the zero COVID policies in Shanghai because the number of cases have actually dropped to like your mid double digits. In a population of 25 million, that's very, very, controllable, very, very palatable. So they've actually eased the restrictions there, which means that manufacturing and consumption can actually again recover back to where it was before. But China opening up also basically means that your prices of commodities will also go up because, demand from China, second biggest economy in the world, is not going to be like demand from Singapore, right? We're tiny. Demand from China for commodities will basically means that firstly, your metals prices will react. Your iron ore prices will go up, copper prices will go up, so on and so forth. And on top of that, Shanghai also announced a 50-step economic package to actually stimulate the local economy. And they've announced subsidies for EVs, right, for electric vehicles, which if I go back to this slide here, it basically shows you that the demand for your metals, for EV batteries, photovoltaic panels is just going to go up, right? So that's going to be increasing pressure on commodity prices in that sense.
Kelvin, I'm going to interrupt you here. With these headwinds,
Yeah.
And with all reserves bank, acting relatively aggressively, including the U.S. Federal Reserve. What are your thoughts around a recession?
Okay.
And do you think a recession is synonymous with a bear market?
Okay. So your question is whether I think there will be a recession and whether the recession will be synonymous with the bear market. Yes and no. If there is a recession, I don't think it's going to happen in the next 6 months or even the next 12 months, simply because the US economy is still on pretty good grounding. I mean, if you look at this slide here, your unemployment rate is at 3.6%. You don't get a recession with the unemployment rate at 3.6%. Unemployment rate has to go up to about maybe 4.5%, because full employment in the US is really actually at 4%. So the market is actually very strong right now, right? So you're not going to get a recession out of this one, not so fast. If you have a recession coming through, that means that there will perhaps be a derating of the equities market. So previously, where valuations are considered fair or attractive, may no longer be so. It might be expensive or not as attractive as before. So you're likely to see actually valuations drop in that sense, right? If you look at the labor participation rate, according to this chart here, which is this line in blue, your labor participation rate has actually come off, right? The workers are not coming back to work, and I think a lot of employers out there will probably be able to resonate with this one. Um, you know, after a massive seismic event like COVID-19, things don't go back to normal. There is always an impact, and I think the biggest impact is being felt in the employment market. Labor participation rate is lower. That means that the size of the labor market has actually shrunk, right? And you can't increase that on a short-term period. Donald Trump, when he was the president, enacted policies to actually make it more difficult for foreign labor to come in. And we're talking about the low-cost worker from Mexico. We're talking about the highly skilled technical workers from China, from India. It's hard for them to get visas now, and therefore the size of the labor market has actually become smaller. And now you basically have the tightest labor market in US post-war history. So how do you resolve this one? Not so easy. It's not going to be resolved overnight, right? So a near-term recession looks unlikely, like we were saying, right? Because if you look at the ISM and the unemployment rates, they're still okay. They've trended down, but they're still pretty much okay, not unpalatable. And this is the biggest elephant in the room, in my view. The Federal Reserve is going to start quantitative tightening. And in fact, I think today they're going to start reducing on a gradual basis. 95 billion on a monthly basis. They've started on a small scale because if you're hiking by 50 basis points in June, you don't want to destabilize the market by pulling out too much liquidity, right? So they're starting this month. And if you look at this chart here, it is very, very difficult to envisage quantitative tightening happening and not affecting the markets. Now, I'm showing you all this because there is a case in point, right? And I'll come to the answer a little bit later on. But you can see that you have a soft target of 6 trillion by the end of Q4. If you do the math, and if the balance sheet is at 9 trillion right now, if you do the math, it's roughly around 125 billion a month. They're at 95 billion, so they will have to pick up the pace later on this year or early next year, right? So it can't be this 95 billion all the time, right? And if you look at some of the research that we have here, you can see that on the right-hand side, R squared is basically the coefficient you generate when you do a regression. You get the sense that more than half of the non-earnings driven market cap changes were explained by the Federal Reserve's balance sheet expansion post the global financial crisis in 2008 and 2009. So there will be an impact on the equities market, especially where the US stock markets are concerned. Okay. Then, this is another very, very popular question that I get, Joe, all the time. Should I be investing in gold because there's so much uncertainty brought about by the Russia-Ukraine war? The answer is no. Gold does not just trade on uncertainty, right? In fact, geopolitical events usually do not have a long-lasting impact on equity markets. So there are basically three conditions that need to be there for gold prices to outperform. The first is uncertainty, and that is now ebbing away because we know that there is already a war. It's going to last for quite some time. So there's less uncertainty there. The second condition for gold to outperform is basically a very weak US dollar. We don't have that. The dollar is strong, right? It might have weakened a little bit recently, but the dollar remains very, very strong. Third condition is that you need interest rates to be on a downward trend or negative, and interest rates are climbing, right? Real interest rates are going up. And I think most homeowners in Singapore will feel it because in the next 6 months, your mortgage rates are going up if you're pegged to a floating rate, like, for example, the 3-month LIBOR or SORA, so on and so forth. It will become more expensive for you to service your mortgages. You have to fork out more, either from your CPF or from your own disposable income to pay for your mortgage. So interest rates are going up. So when you have only one, and it's basically only one condition, or maybe even half a condition available out of the three, gold prices are not likely to actually outperform. And in fact, I do think that there's room for gold prices to fall, perhaps to the $1,700 per ounce level in that sense.
So now we're going to lead into the positivities of this session.
Okay.
So what are the bright spots?
Yeah. So it's not all negative, right? Don't walk away thinking that, oh my God, everything is so gloomy, it's so gray out. I know today it's a bit gray, it's a bit rainy, right? No matter what kind of market you're in, it is possible to actually generate returns, right? It's just that you have to be more savvy, you have to be more careful, because when you have a bear market, and the Nasdaq is in a bear market right now, that means that the low-hanging fruits have been plucked, right? So you have to be a little bit more careful in that sense. Now, Asia remains very, very attractive. If you look at this slide here, Asia's earnings growth this year, even if it goes down to 10%, is well above the longer-term average of anywhere between 2.6% to 0.9%, right? So Asia looks pretty attractive. And of course, China is the market that I think has the biggest potential to move. In fact, MSCI China in the last 6 weeks has actually outperformed US equities. And the Chinese government will actually have to expand monetary policy. They have to ease further in order for them to even meet 4% of GDP growth this year. Their target is 5.5%, but there is no way they'll meet 5.5% this year. Even the ease significant from here on, 4% is a more achievable, realistic target in that sense. Okay. And when do you want to invest in the market? Do you want to invest in the market when GDP growth and earnings growth is near the top, when stocks are expensive, when investors are extremely bullish, and when the policymakers have actually turned restrictive? No, it's the other way around. And if you look at China here, China basically ticks all the boxes, right? So that's one of the reasons why we like China. And on top of that, the capital flows into China will increase dramatically. The pie chart on the right is very telling, right? We estimate that renminbi-denominated assets as a percentage of global portfolios will amount to 10% by 2030. Right now, it is at 2%. Just 2 months ago, the Israeli central bank actually announced that they will increase the renminbi-denominated assets as a percentage of their reserves to 2% from 0% currently. So that is going to go up, and that has actually already started, right? And on top of that, China is cheap. If you look at the valuations, China is actually trading at 1 standard deviation below the historical average. Okay, and if you look at the regulation tightening, the risk is over. In fact, Premier Li Keqiang has on several occasions stated that they will actually help the tech sector stabilize and grow, because in order to meet China's Made in China 2025 target, you can't be tightening all the time, right? You need to give them some space to grow, and I think that's actually come through. And with that, I think China is actually in a nice place. But again, you have to be very careful. You have to be diversified, because diversification is key to what we do as an investor. I mean, just ask investors who put all their money into the cryptocurrencies, into UST or Terra in the last month or so. They will know what we're talking about here, right? So
No, and this is, I think we're at the right point now, which is where the majority or all of our attendees are here today.
Yeah.
Diversifying, into private markets,
Mhm.
diversifying into private equity, venture,
Yeah.
real estate,
Mhm.
credit. How to do it? How
Yeah.
do the best people
Yeah.
do it?
Okay.
Yeah, and the resilience of that.
Absolutely right. So why do you need to diversify? Because some people don't believe in diversification, right? I mean, they will tell you things like diversification is for people who don't know anything, right? If you know it really well, why do you need to diversify, right? So the key about diversification is humility. You can make 10 investment ideas, 9 ideas might be good. Last one is a bad idea. It will completely destroy whatever you've actually made in the last. Okay, and I've seen that happening before, right? I've been investing for the last 26 years, and that has actually happened to quite a few people who don't believe in diversification. So it's about being humble in that sense, right? So I had the privilege and honor of working with Ray Dalio recently, and he basically told me that you put your money in the 9th best idea because your first 8 ideas might be wrong, right? And his approach when he created Bridgewater, which is coincidentally the world's biggest hedge fund, was that it was much more achievable to find 10 good and unrelated return streams than to find one perfect investment, right? You might be waiting years for that one perfect investment to come, and it may never ever come. And if it does come, let me tell you, when things sound too good to be true, they usually are too good to be true. Okay, so better be careful. There's no such thing as a free lunch out there. Okay, and you know, and you also want to diversify because it's almost impossible to predict black swan events. Yeah, we can predict a bear market, we can predict a recession, right? We can forecast certain things here and there. But COVID-19, Fukushima earthquake, SARS, 9/11, it's almost impossible to actually forecast these events. So you need to be humble. You need to actually tell yourself, that you can't forecast a lot of these things from happening, right? Even the Federal Reserve. The Federal Reserve has like 256 PhD rocket scientists, economists, right? And they couldn't even get inflation correct, right? I mean, they only had 2 tasks, right? Inflation and unemployment, and they got one wrong, right? So if they can't get it correct, who else can, right? Maybe you can, but I don't know. I don't think I can. And if you want to try to time the market, I mean, look at this slide here, right? We're going all the way back to 1959. We're not plucking numbers from the sky, right? So this is basically, if you look at this slide here, and I'm referring to it here, growth of $100 invested in the S&P 500 in 1960 versus a buy low, sell high market timing strategy, right? And you can see the blue line is wait for a minus 10% correction and buy. It will grow to like $534. The other line, buy and hold, because of the compounding as well, you are basically at 46,886 US dollars. So, the data is all there, right? These are not numbers that we can pluck from the sky and just give it to you. It's all there, right? And of course, when you have a concentrated portfolio, and I think a lot of us are guilty of that, especially if you've inherited money from your grandparents, tell you, oh yeah, I bought OCBC, 2 decades ago.
Yeah.
It's a great company. We've made a lot of money. It's a great company, but you have single stock risk, single stock exposure. You don't want that, right? Because sometimes, black swan events might actually happen. So you want to be diversified in that sense. So broader diversification enhances.
This is an amazing slide. This is
returns.
actually one of my
Exactly.
favorite slides. So please.
Yeah. And again, if you look at this, right, there are basically 2 bar charts there. The gray one is basically your global buyout growth equity pool internal rate of return. Your blue is basically your MSCI world, right? And you can see that the returns when you have private equity is always higher. We're not saying don't invest everything in the public markets, invest everything in the private equity. Not saying that, or private markets. Not saying that. What I'm trying to stress here is that there is a huge opportunity set in the private markets. And I think a lot of people are not aware of that, right? Because the publicly listed companies get all the glory, they get all the headlines, right? You get company reports, quarterly results season, you get very flamboyant, charismatic CEOs speaking because it's available for anyone who wants to invest. Private markets may not necessarily be that way for a very long time, and therefore they don't get the kind of publicity that the publicly listed companies get, and that's why a lot of people are not aware of the opportunity set. But let me give you some numbers there. 90% of the investment universe in the US, right? Now we're talking about the US markets here. 90% of the investment universe is actually in the private markets, not in the publicly listed markets. The publicly listed markets, despite the fact that your S&P is so high at 4,100 points, constitutes only 10% of the investment universe. So you only invest in the publicly listed stocks. You miss out on 90% of the investment opportunities there, right? For a market like China, it's even bigger because China is a very young market, right? The equity markets proper only started in the 90s. And in fact, if you want data on China, Chinese equity markets, you can only get it from like 2010 onwards with any sort of rigor or robustness. So for the Chinese market, I would think that the investment universe is probably above 95%, where the private markets are concerned. So if you only focus on the listed stocks there, you're missing out on a huge part of the investment universe, right? And the more sophisticated endowment funds actually do that, right? We call that the endowment style of investing. And if you look at this chart here, I know it's a terrible slide to look at. There's so many colors, so many words, so many numbers there, right? But let me run you through. So the different colors represent different endowment funds from the universities in the US, right? So you have Yale, Harvard, Princeton, Stanford, etc. And then you have basically 5 asset classes there: cash and fixed income, equities, private equity, real assets, and hedge funds. And then below, you have the key university endowment performance. So you have, for example, Yale, which on a 10-year track record basis, if you go down to the column on the right, it's basically 12.4 per annum, right? So why is Yale doing so well? If you look at the asset allocation, it's because they basically have 41% in private equity. And that's why their performance is really, really good. If you look at another university with just a very high equity allocation, and that's basically NTSE, that's 33%. If you look at their returns, not so great, right? So if you look at that, you can see that having private equity exposure really, really helps with your portfolios. Now, on top of that, the the investment universe in the private markets is not just private equity. We haven't heard very much about private debt in the last 12 to 15 years because your interest rates were so low, because the Federal Reserve was doing QE. So it's very hard to actually invest in private debt when your yields are very low, right?
Yep.
But now the equation is changing because now your interest rates are going up and they will remain high for quite some time because the structural case for higher inflation is a lot stronger. Inflation is not going to go back to where it was before pre-COVID-19. It will basically be at the current levels, maybe lower, but it will always be higher. And I'm talking about perhaps 2.5% to 3% compared to the Federal Reserve's target of 2%, right? So we have to actually live with that, right? Which means that your interest rate will be higher than before. And another very interesting slide, this one, it shows you the risk return of the various asset classes, and you can see that where your private debt, your hedge funds, your private real estate, and your private equity is concerned, the returns are higher or similar, but the risk is actually lower or similar than the traditional asset classes. So there you have it, right? Reasons why you need to be diversified. And on top of that, reasons why you want to be invested in the private equity, private market space as well. And it's not just private equity, there's hedge funds, there's private real estate. Now, private real estate is different from listed real estate, right? Private real estate basically means that you're investing in a fund, a private market fund that has pulled together resources to invest in certain specific projects with a very steady yield, return, or cash flow coming through on a regular basis, right? So it's quite different from investing in a REIT or investing in a listed public developer stock, so to speak, in that sense.
That's a great summary, Kelvin. Thank you. So for all participants today, it's a good time now for you to submit your questions. I'll be taking live questions for Kelvin. So kicking off, Kelvin, we had questions around hedge funds.
Right.
Is it true that hedge funds generally thrive in a high vol environment?
Yes and no. There are many, many types of hedge funds. There are funds that thrive in a high volatility environment, and I think your long short funds are those, because if the volatility is high, they can go long, they can go short, right? Hedge the positions and make quite decent returns there. If the markets are just trending up and there's very low volatility, the short side is not going to be working to their advantage, right? But there are other funds that can do well in all sorts of conditions. So if you're not very familiar with hedge funds, what you want to do is you want to invest in a fund of funds, right? A fund of hedge funds.
Multi-strategy.
Multi-strategy, right? Where you not
Yeah.
just have one strategy, you have, arbitrage, M&A, you have macro, you have long short, all sorts of strategies in there. Again, that's another layer of diversification, right? And that will actually help you do pretty well in that sense.
Second question. In this current rising rate environment, how would private credit benefit?
Yeah. Well, if you put your money into bonds right now, you are vulnerable because of the increase in interest rates. Because when interest rates increase, bond prices come off, right? And the bond yields are still low, but there is very, very decent chance that the bond yields will actually go up. Let me give an example. Why would you want to buy a REIT right now that's giving you 4.5% yield when the 5-year Singapore government bonds are yielding 2.5 to 2.7%? Why would you do that? Singapore government bonds is risk-free. Your REITs are not. Your REITs listed in the stock market carries stock market risk as well. Interest rates going up is not to the advantage of the REIT because they have borrowings, right? So their cost goes up. Cost goes up, their profits are lower, the distributions will be lower. So they are impacted both ways. So why would you want to do that, right? You want to be invested in a solution where, if rates go up, they benefit in that sense because it's actually floating. So private credit is one asset class that actually benefits from that. And how did the private credit market actually grow? It's actually because of the global financial crisis, because the banks have been constrained by a lot of regulatory new regulations coming through. So they can't really lend to a lot of the different players in the market as they can before. And the risk appetite has actually shrunk. So they are very selective in what they do when they do lending. So the private credit market has actually basically come up to address this need for that. In China, the private credit market will be called shadow banking, right? Which sounds terrible, but it is basically that it's private credit actually, in that sense. So it's risen to fill a niche that needs to be filled. Doesn't mean it's all fine and dandy. It means, I mean, there are always risks with regards to every investment. But if you again do your studies carefully, if you're not familiar with it and you let the professionals do it, I'm pretty sure they can do a pretty good job with the due diligence and the risk assessments of the particular loans that they're going out in that sense.
Back on the private equity
Yeah.
topic, Kelvin, we've seen tremendous mark-to-markets and revaluations in public markets.
Yeah.
What is your view on how it will impact private markets?
Okay.
And in particular, this year's vintages of private equity funds?
Well, private markets, you tend to invest over the entire cycle and not just one cycle. Okay. Now, even if we get a recession is not a collapse of the markets. I get very nervous whenever I use the word recession because everybody thinks, oh my God, the markets are going to collapse, right? No, it is not. Okay, please do not go away with the wrong idea that I think the markets are going to collapse. No, it's not, right? Recession is simply 2 quarters of negative growth. Okay, and you might get a period of very stagnant share prices, very stagnant market performance, but it doesn't mean that the market's going to collapse like what we had in 2020 because of COVID-19 or what we had during the global financial crisis. It is not. It is just simply the fact that you get 2 quarters of negative growth. Okay, so that is okay because the public markets will be able to write that. The private markets will certainly be able to write that. And if you really want to be very, very careful there, you can actually invest in different vintages of private equity, right? And it will basically help you weather the storm. In that sense, in most cases, I don't think private equity is actually vulnerable to interest rates unless interest rates go up to the Paul Volcker level of like 20% back in 1980, 1981. Then yeah, everything gets hurt, right? But very, 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 very unlikely in that sense for that to actually happen.
In building an alternatives portfolio, I mean, we've spoken at length about diversification. Would you have diversification across what we've just been speaking about? Private equity, venture, hedge funds, real estate.
Absolutely, yeah. I mean, if you have put all your money into venture, I think you'll be sweating buckets right now because that market is simply dried up, right? And you don't have to go far, draw that analogy there. Just look at all the loss-making tech stocks on NASDAQ and even in Singapore. They're all down 70, 80%, right? Why is that the case? It's because liquidity is drying up. Why is liquidity drying up? Because your interest rates are going up, right? Because your Federal Reserve is doing quantitative tightening, because the ECB is increasing interest rates, because the ECB even though they're still printing right now, and I'm pretty sure that they'll have to tighten in the next few months, right? So if every major central bank out there, other than the Chinese central bank, is tightening, where are you going to get the liquidity from? So if you're just into one particular segment, like say, for example, venture, because the returns are, wow, fantastic, and it's really, really exciting, I think you're going to be hurt. So you need to diversify across the different strategies in private equity as well, in that sense.
And I mean, on average, in terms of IRR, if we take benchmark returns, how would you rank from lowest to the highest VC, PE, and hedge funds?
Well, I think your hedge funds are more steady in that sense. They are meant to give you a targeted return over a certain period of time, right? So that's likely to be the lowest volatility in terms of the returns, assuming that you want to mark to market on a regular basis. Your venture will tend to give you the potentially the highest returns, right? Because of the fact that you're going in at a very early stage. But it is also, of course, the highest volatility because of the fact that, a lot of startups don't make it. Okay, it's fact of life, right? And conditions are getting even more difficult now because of the higher rates of return, the refinancing costs, borrowing costs, etc. Okay, so I would say that your mature private equity space will probably be the more, I would say, the lower level of risk. But at the same time, your IRRs are not going to be as sexy as your venture cap, right? Or your angel investors in that sense. But you don't take that much risk. I mean, what are you looking for, right? Each one of us has different levels of risk and return. I mean, Jocelyn here, who's very young, has a long runway. She'll have a very different risk return appetite than from me, right? Because I'm a lot older, right? So my risk return appetite will be a lot more different profile compared to Jocelyn. So you really need to sit down and ask yourself. And then on top of that, private equity is, can you afford to lock your money away for quite some time? Because there's no liquidity, for the 5-6 years that you're looking at, right?
Except at ADDX.
Except for ADDX, yeah, well, which is great, right? But for most private equity funds, there's hardly any liquidity, right? And if you can invest it, I would say don't take it out because you want it to compound, you want it to grow, right? I mean, don't treat your private equity investments like a stock investment. If you want liquidity, don't invest in private equity. Invest in the stock market. It's far less of a headache in that sense.
Coming back to credit, there's a question around rising default rates, potentially rising default rates. Do you share that view, and how would it impact private credit?
Yes and no. Yeah, default rates will rise, but if interest rates don't go up to the 12-10% level, and they're not likely to, even if they go up to the 5% level, I'm actually quite confident that the default rates are very, very manageable for very good reason. Corporates are still sitting on bundles of cash, right? So they're not over leveraged. If they're over leveraged, then yes, you have a problem, like what we have with the Chinese property developers, right? Because they were over leveraged, and when the government tightened the sources of financing dried up, and then they got into trouble. But I think with the rest of the world, especially in the US, where the listed companies, as an indication is concerned, and even in Europe, they are not over leveraged. The good news is that we had a major crisis back in 2008, and that shook us up, shook the system up. Lending standards were actually tightened compared to the period before the global financial crisis, and therefore corporates, even if they wanted to, they can't overborrow, right? You look at Asia, government debt as a percentage of GDP, the average is, even after what they spent with regards to COVID-19, is at about 75%, which is actually very, very manageable, right? And I'm talking about, sorry, the average is actually about 45%. 75%, I'm referring to Malaysia and India, the two most highly indebted countries in Asia. But the average is 45%. You strip out India and strip out India and Malaysia, the level comes down to about 45%. You strip out Singapore, which is net cash. You strip out Hong Kong, which is net cash. The rest of the economies, their debt levels are again around 45 to 50%. So it's very, very manageable in that sense. So I really don't expect default rates to go up in that sense. But of course, if you want to look at the higher risk categories like your high yield, your US high yield, or your Asian high yield, then obviously that's going to be a little bit more risky. But even then, if you strip out the Chinese issuers, I don't think you have an issue there. Last year, Asian high yield had a massive beating, right? You strip out Sri Lanka, you strip out the Chinese high yield issuers, the index was actually very, very okay, actually.
This is a question on your pet topic, actually,
Oh, wow.
which is China.
Okay.
Is it better to invest in the Chinese market via Hong Kong, or the local exchange?
Well, they're quite different.
Local
Yeah.
Chinese exchange.
Yeah. The Chinese stock market combined is the world's second biggest stock market right now. If you invest in the H shares, which is the Hong Kong listed Chinese companies, you're investing only in a handful of companies, right? Those are the well-known names, and they're largely in the consumer space. Alibaba, Tencent, they're in the consumer space. They might be tech companies, but they are actually in the consumer space, right? Because of the way they are structured. But if you're investing in the domestic consumption story in China, and the domestic consumption is the sexiest part of it, because of the fact that you have a burgeoning urban middle class, growing affluence, highest spending levels, etc. After COVID-19 is over, that is largely captured within the A shares, the Shanghai, Shenzhen listed exchanges. Okay. On top of that, if you want to list in the super high tech companies, if you want to invest in the super high tech companies, a lot of that is actually in the Shenzhen Stock Exchange. If you want to invest in the EV story, right? A lot of the component suppliers are in the Shenzhen Stock Exchange as well. If you want to invest in the Greater Bay Area, that is also in the Shenzhen Stock Exchange, not in the Hong Kong Stock Exchange. So I think that you probably want to have both, but you cannot ignore the Shanghai and Shenzhen, especially the Shenzhen Stock Exchange. You need to. And of course, increasingly over the next few years, the Beijing Stock Exchange as well. Okay.
We now have a question from actually a very sophisticated investor.
Okay.
His question is, given the current market conditions, the uncertainty, high inflation, supply side issues, geopolitical risk, what sort of specific verticals in PE would you look at?
I don't think you should actually isolate it in that way, because again, the space is actually quite wide for almost all the different strategies to actually make some money, right? Perhaps with the exception of the venture cap angel investing part. But even in angel investing, if you're in sustainable investing, I think that's a great story to come in through. If you're in the venture capital space, I think that's a great story to come into as well. But it's just that the returns are not going to be as strong or as high as what you had before, simply because now there's a lot more sanity. Your valuations are likely to be a lot more reasonable, given that your risk premiums have actually, you need a higher risk premium to compensate you for the higher risk, for the higher interest rates, right? So I wouldn't look at it in terms of the verticals in that space. I think where if you have to single out any particular industry, I would think that it's basically the ESG story that still remains very, very strong, because I think this trend of investing in the environment change is an irreversible trend. Um, Regardless of whether we like it or not, even if the funding doesn't come from the private sector, it's going to come from the governments, because they're committed to the Paris Accord, to keeping temperature rises to a certain degree. So there's still quite a fair bit of capital moving into that direction.
Thank you. Okay, we're right on 5:45, so we will probably take 2 to 3 more questions.
Yeah, I can do this all day.
For all participants, you've heard Kelvin. After today, if you would have more questions, please feel free to email them into ADDX, and we'll make sure we get it through to him. Given who we are at ADDX, we're going to end off with a few digital questions. Okay. What are your views around tokenization? Have you been keeping up with the crypto market?
Yeah.
And how are you reacting to them?
Okay. With that, I need to answer another question first. Was there a bubble in the digital asset markets, right? And I think certainly there was a bubble, because of the fact that you couldn't justify a lot of the hype, a lot of the valuations, a lot of the a lot of what was actually going through at the point in time, right? And usually when you get a bubble, you'll find that the stories become pretty incredible, right? And for me, there was a pretty big bubble there. But again, not many people got hurt when the bubble burst about 2 months ago, because it was not a widely held as a class. Okay, but I think it is healthy because you need some sanity to come back in. You need a healthy consolidation of that particular market itself because there was just too much going on and there was too much resources being wasted, right? So you still need some sanity to come back through. But I do think that there is a space for that. I don't think it is something that is a fad. It is a trend. It's not a fashion. It is a trend, and trend changes are permanent. Um, the digital asset space is big. There's so much, right? So what am I referring to? I think there's space for crypto, but I think it is still very early days, and the role that crypto has in the digital world will likely be quite different from what it has right now. Okay, um, I will give you the analogy of the handphone. Right, when I had my first handphone, it was a Motorola StarTAC, the flip phone. And I can assure you, a lot of the guys working in the background here, they will have no clue what that is all about because they were not even born when I actually had that phone. Okay, would I have actually imagined that it would actually evolve into like the iPhone and how we use it today, where you can actually pay for stuff? I can watch a movie, I can search for information, navigate my way here from UBS. No, not in a million world, right? So I think that is exactly what's going on in the digital space right now, right? If you ask me about the metaverse, I can assure you that the metaverse is here to stay, but it will be in a very different form from what it is right now as well. Tokenization, yes, I do believe in that because it's very efficient, painless, and the cost of tokenization is so much lower than what we have right now. But again, the final form, or the eventual form, 5 years down the road, will again be very different from what we have right now, right? And again, I can see that, right? When I first started working, buying and selling shares still involve exchanging of share scripts, something that Jocelyn probably won't identify with because she's too young to notice that, right? But share
That's
scripts, you know,
why we're
paper.
such good friends. I can go to you for advice all the time.
Now it's digital, right? You don't even know whether you bought anything, right? But you know that you have because it's in your CDP accounts, it's in your custodian accounts. So what I'm saying here is that but it will evolve, and it will evolve in a pattern that probably you and I will not be able to actually visualize at this point. So yes, there is a space in it. But again, be very careful because every time you have an evolving technology, you have to go through the ups and downs, right? When the Nasdaq bubble burst in 2000, Amazon was one of the premier companies. The share price crashed. Guess when did Amazon share price recover? 2015. 15 years, for Amazon to even at least come back a little bit, right? Before it basically went like that vertical to where it is today. So please be careful. And that's why, again, I stress the D word.
Diversification.
Exactly.
Yeah. It's almost it should be ingrained in your minds by the end of this session. I think we'll close off with we usually close off with this question, Kelvin, and you can probably predict it. What is your personal asset allocation at the moment, and will you be making any shifts in the near future?
I'm gonna make you guys very happy because of my role. I'm not allowed to invest in single stocks because of the fact that it's a conflict of interest in that sense. And it's very hard for me to take FX positions as well because I have to get approval and you have to hold for a certain period. And in the FX world, 5 days is an eternity, right? So it's very tough. So most of my investments in the private market space. It's really a space that I believe in. And with that, I don't have to worry about what the S&P is going to do today, right? A lot of people ask me, where do you think the S&P has bottomed out? Or do you think it's going to go down another 15% to 3,500 because it needs to trade on a 20-year valuation of 15 times earnings, etc., etc., etc.? I don't have to because I'm prepared to sit out the entire cycle because I don't need to utilize the invested capital, right? So I'm willing to sit it out and let it grow and let it give me decent returns in the future. I'm not greedy in any means, right? I'm just looking for decent returns on a 5-8 year basis. And that's it. That's what I look for. Yeah.
Thank you, Kelvin.
Thank you. Thank you for having me.
No, it's a pleasure to have you. We're very grateful for all your thoughts today and your sharings. Extremely insightful. So to all the participants today, please continue engaging with us at ADDX. We have tremendous number of new listings coming through, and you will be most definitely informed of in all the segments of private markets that Kelvin spoke about. Have a great evening. Thank you.